Disclaimer.
October 8th, 2024. A Tuesday morning that looked like any other in the London metals markets. Traders sipped their coffee, screens flickered with the usual price movements, and then someone placed an order that broke the entire global silver system in under 4 hours. One single buyer. 1,000 tons of physical silver. India's central bank wanted delivery, not paper promises, and what happened next should terrify anyone who owns stocks, bonds, or thinks their retirement account is safe. The overnight silver lease rate exploded from 0.25% to 200%. Think about what that means for a second. Banks were paying 800 times more to borrow silver than they were the day before. That's not a market adjustment. That's panic. That's the sound of someone realizing the metal they promised to deliver doesn't actually exist in their vault. Here's what should grab our attention. Silver just completed the most violent rally in modern commodity history, surging from $29 an ounce in January to $75 today. That's a 158% gain in less than 12 months, the best performance since 1979 when the Hunt brothers tried to corner the market. But this time, there are no billionaire speculators trying to manipulate prices. This time, the buyers are sovereign nations, industrial manufacturers, and central banks who've done the math and realized something the rest of us are just starting to figure out. The physical silver doesn't exist. Let me put this in perspective. You walk into your bank right now and ask to withdraw $10,000 from your savings account. The teller smiles, processes your request, and hands you cash within minutes. That's how banking is supposed to work. Your money sits in the vault. You can access it whenever you want, and the system functions because there's actual dollars backing up the numbers on your screen. Now imagine you own silver through an ETF or a futures contract. You paid $75 an ounce, you've got a certificate saying you own 100 ounces, and you decide you want the actual metal delivered to your home. According to London Bullion Market Association data, there are 408 paper claims for every single physical ounce of silver in existence. You and 407 other people all own the exact same bar of silver, except only one of you is going to get it when this system finally breaks. The math is getting ugly fast. COMEX and LBMA inventories have collapsed from 290 million ounces at the start of 2024 to just 210 million ounces today. That's a 27.6% drop in available silver while prices doubled. In a normal market, when demand surges and prices rise, suppliers rush in to sell more inventory. The exact opposite is happening. The higher silver climbs, the faster the vault's empty, because everyone who actually holds physical metal realizes they're sitting on something far more valuable than the current spot price suggests. 5 unnamed U.S. banks are now holding their largest short position in 8 years. According to the latest Commitment of Traders report from the CFTC, these institutions are short 194.43 million ounces of silver. Every time silver rises by $1, they lose $200 million. Do the calculation with me here. Silver started the year at $29 and we're now at $75. That's a $46 move. Multiply that by their 194.43 million ounce short position, and you get losses exceeding $9 billion in less than 12 months. Someone had to liquidate. Someone already did. The question keeping traders up at night is not whether a major bank failed, it's which one went down first and how long regulators can keep it quiet before the public finds out. Because when that announcement hits the news wires, when Americans see a major U.S. financial institution collapsed from silver derivatives exposure, the rush into physical metal will make the current shortage look like a practice run. Think about our national debt for a moment. We're sitting at $36 trillion, adding another trillion every 100 days. And the only reason the dollar still functions as the global reserve currency is because other nations trust our financial system more than they trust their own. What happens to that trust when the world discovers our largest banks have been selling hundreds of millions of ounces of silver they never actually owned? What happens when industrial manufacturers in Germany, Japan, and South Korea realize the silver they need for solar panels, electronics, and batteries might not be available at any price because Wall Street turned our commodity markets into a casino? The overnight lease rate explosion on October 8th wasn't just a technical glitch. When banks need to borrow silver for delivery and they are willing to pay 200% interest for a few days, that tells us the situation is far more desperate than official statements admit. These are sophisticated institutions with trillion-dollar balance sheets. They don't panic over small problems. They panic when they've promised to deliver something they can't find anywhere on the planet. Pop quiz. What's the one commodity that's simultaneously a precious metal, an industrial necessity, and America's most important strategic resource for the clean energy transition? If you answered silver, you're starting to understand why this crisis is different from every other market correction we've seen. Gold you can skip, it's beautiful, it's traditional, but the economy doesn't stop if gold becomes expensive. Silver is in your phone, your car, your solar panels, your water purification system, and every advanced weapon system our military depends on. We use more silver every single year than we mine out of the ground. World Silver Survey data shows global demand hit 1.19 billion ounces in 2023, while mining production only delivered 830 million ounces. That deficit has to come from somewhere, and for decades, it came from above-ground stockpiles that governments and investors accumulated over generations. Those stockpiles are nearly gone. The COMEX vaults that once held over a billion ounces now hold barely 210 million, and half of that is already pledged to existing delivery contracts. Here's where it gets personal for anyone planning to retire in the next decade. Your 401k probably holds stocks in companies that depend on affordable silver. Your bonds are denominated in dollars that derive credibility from our stable financial system. What happens to both when the market discovers that our commodity exchanges have been running a fractional reserve system that would be illegal if we tried it with actual currency? The Federal Reserve learned in 2008 that you can print dollars to save banks. You can create trillions out of thin air, bail out institutions, and inflate your way out of a debt crisis. But you cannot print silver. You cannot create it with a computer keystroke. Every ounce has to be pulled from the earth through mining operations that take years to develop and billions to finance. And right now, we're consuming silver faster than anyone thought possible, while the available supply shrinks by the day. That unnamed bank that liquidated? They were probably the smart ones. They saw the India order break the lease rate market, and they got out before the real panic started. The other 4 banks, holding massive short positions, are still in the trade, still hoping prices collapse, still believing they can somehow deliver metal that doesn't exist in quantities they've never seen. One of them will be next. And when the announcement comes that a major U.S. financial institution has failed from commodity derivative exposure when regular Americans see their trusted banks brought down by something most people don't even know exists, the rush into physical silver will make every previous shortage look like a warm-up act. We're watching the early stages of a crisis that combines the worst elements of 2008, its financial collapse with the 1970s commodity supercycle. The difference is, we're not talking about subprime mortgages or oil embargoes. We're talking about the foundation of modern technology running out of its most critical component, while the banks that promised to supply it discover they've been selling promises they can never keep. You want proof this isn't just market speculation or conspiracy theory? Let's talk about what happened when one of the world's largest precious metals refiners decided they'd rather shut down their entire silver operation than try to navigate what's coming next. Metalor Technologies, a Swiss company operating in 17 countries, announced in late November they're completely exiting silver trading until January 2026. Not reducing operations, not limiting exposure, complete shutdown. This is a firm that's been refining precious metals since 1852, survived 2 world wars, the Great Depression, and every financial crisis of the modern era. They've seen volatile markets before, they understand risk management. They just told the entire industry they'd rather sit out for 14 months than try to source physical silver in the current environment. Think about what that decision cost them. Metalor processes billions of dollars in metals annually. Their silver division employed hundreds of specialists, maintained relationships with mines and industrial buyers across every continent, and generated steady profits for over a century. Walking away from that revenue stream isn't a cautious business decision. It's an admission that continuing operations creates risks they're not willing to take. Here's what they know that most investors don't. The gap between paper silver prices and physical delivery costs has become impossible to bridge. When a major manufacturer orders 10,000 ounces for industrial use, they expect delivery within weeks at the quoted spot price plus a small premium. That system worked for decades because refiners could source material from mines, recyclers, and above-ground stockpiles. Those stockpiles are gone. Mines are selling directly to long-term customers. Recyclers can't keep up with demand. And refiners like Metalor found themselves caught in a vice where fulfilling contracts meant losing money on every single transaction. China saw the same problem and made an even more dramatic move. On November 3rd, they banned all silver exports. No exceptions, no phase-in period, immediate full stop. The world's largest silver producer just told the global market they're keeping every ounce for domestic use. And if you want to understand how serious our supply crisis has become, that's your answer right there. But here's where it gets really interesting. Industrial buyers aren't waiting for the exchanges to fix themselves. They're bypassing COMEX and LBMA entirely and negotiating directly with whoever has physical metal, paying whatever price necessary to secure supply. This creates what traders call ghost supply. Silver that is being bought and sold in transactions that never appear in official market data, because they're happening outside the traditional system. South Korea just executed the biggest ghost supply deal in modern history. $76 billion. Let that number sink in for a moment. The South Korean government went directly to the Shanghai Gold Exchange and negotiated a direct purchase that drained over 1,000 tons of silver from Shanghai vaults in just 3 months. According to Shanghai Gold Exchange data, that's 2/5 of their total silver inventory wiped out by a single buyer. Why would South Korea spend $76 billion on silver right now? Because their entire economic future depends on semiconductors, advanced batteries, and solar technology. They've done the projections, and they know what's coming. The International Energy Agency estimates that solar panel production will require 85 to 98% of current global silver reserves by 2050. South Korea is a peninsula with limited natural resources. If they don't secure their industrial silver supply now, their manufacturing base becomes dependent on the goodwill of whoever controls the remaining stockpiles 20 years from now. They're not the only sovereign nation hoarding before the public realizes what's happening. Central banks that spent decades accumulating gold are quietly pivoting to silver. The World Gold Council won't publish these numbers for another quarter, but industry sources confirm multiple Asian central banks have begun building silver reserves through the same direct purchase channels South Korea pioneered. Have you noticed the pattern yet? Every major player with access to real information, refiners, industrial manufacturers, sovereign nations, is acting like the official market price bears no relationship to physical reality. They're either shutting down operations, banning exports, or paying massive premiums for direct delivery outside the exchanges. The only entities still pretending everything is normal are the banks holding those massive short positions and the exchanges profiting from the paper trading volume. Speaking of exchanges, let's talk about what happened on November 19th when COMEX shut down silver futures trading in the middle of a record volume day. The official explanation was adorable: data center cooling issues. Their press release claimed that excessive heat in their Chicago facility required a temporary halt to maintain system stability. Pop quiz: what's the probability that a professionally managed data center designed with multiple redundant cooling systems and monitored by engineers 24 hours a day suddenly experiences catastrophic cooling failure on the exact day that silver futures hit their highest trading volume in 8 years? About the same probability as your car breaking down only when you're late for the most important meeting of your career. Here's what actually happened. The trading algorithms that banks use to manage their short positions went into forced liquidation mode. When silver spiked above $73 that morning, their risk management systems detected losses exceeding preset thresholds and began automatically buying contracts to close positions. That buying pressure pushed prices even higher, triggering more algorithmic liquidations, creating a feedback loop that threatened to send silver to $100 within hours. CME officials watched their screens showing a cascade failure developing in real time. If they let trading continue, several major banks would have faced margin calls they couldn't meet, industrial shorts would have been forced to cover at any price, and the entire silver derivative market would have experienced what traders call no bid, a situation where there are literally no sellers at any price because everyone holding physical metal realizes it is worth more than the highest offer. So they pulled the plug, blamed it on cooling systems, halted trading for 6 hours until the algorithms reset, and the banks scrambling to source physical silver could regroup. When trading resumed, the price had mysteriously dropped back below $70, volatility measures had normalized, and everything looked stable again. Except it wasn't stable, they just bought themselves time. You want to know how desperate the situation has become? Start calling bullion dealers and ask about delivery times. 10 years ago, you could buy silver coins or bars and receive them within a week. 5 years ago, wait times stretched to 2 or 3 weeks during busy periods. Today, reputable dealers are quoting 8 to 12-week delivery windows for standard products, and several have stopped taking orders entirely for anything beyond small retail quantities. The United States Mint suspended sales of Silver Eagles multiple times in 2024 because they couldn't source enough planchets from their suppliers. This is the official government mint, with priority access to domestic silver production, struggling to produce coins because the physical metal isn't available. If the mint can't get silver, what chance do regular investors have when the real panic starts? Industry insiders are sharing stories that won't hit mainstream news for months. A major European bank tried to deliver silver against a maturing futures contract in October and had to scramble across 3 continents to source the required metal. They eventually paid a 25% premium over spot price through private channels, delivered late, and still lost money on the transaction. That bank quietly exited all future silver obligations the following week. Another major institution attempted to borrow silver for a short-term trade and discovered that institutional lenders were demanding collateral worth 3 times the value of the borrowed metal, plus interest rates above 50% annually. That's not a lending market. That's institutions telling each other they don't trust anyone to return borrowed silver because they know there's not enough to go around. The data from the London Bullion Market Association paints a picture that should concern everyone. Their vaulting network, which handles the majority of institutional silver trading, reported a 32% decline in allocated silver holdings since June. Allocated means specific bars assigned to specific owners, the real metal, not paper claims. That silver is leaving London vaults and going somewhere that the LBMA can't track, which means it's either heading to private storage, sovereign vaults, or industrial stockpiles, where it'll never return to the trading system. Meanwhile, our financial media keeps telling us the silver rally is just speculation, just Reddit traders and conspiracy theorists driving up prices. They're not mentioning the refiners shutting down, the export bans, the exchange trading halts, or the desperate premium buying in private markets. They're definitely not explaining why the gap between paper prices and physical delivery costs keeps widening despite silver's massive price increase. What we are witnessing is the orderly disintegration of a market that functioned on trust and fractional reserves for so long that everyone forgot physical delivery was supposed to be possible. That trust is gone. The refiners know it, the sovereign nations know it, the industrial manufacturers know it. The only people who don't seem to know it yet are regular investors watching their stock portfolios and assuming the financial system still works the way it did 5 years ago. It doesn't. And when that realization spreads from insiders to institutions to the general public, we're going to discover that $75 silver was the bargain of the century. Let's do some math that Wall Street doesn't want you thinking about. Gold is currently trading around $4,530 per ounce. For most of human history, the gold to silver ratio held steady at 15 to 1, meaning 15 ounces of silver bought you 1 ounce of gold. That ratio made sense because both metals came from the same mines, required similar effort to extract, and served as monetary metals that civilizations trusted for thousands of years. Take gold's current price and divide by 15. You get $302 per ounce of silver. That's the historical equilibrium price if the ratio reverts to its long-term average. We're currently at $75, which means silver is trading at roughly 4 times below where it should be relative to gold. But here's where the calculation gets really interesting. Gold is primarily a monetary metal and a store of value. Central banks hold it, investors buy it for wealth preservation, and industrial use accounts for only about 10% of annual demand. Silver is the opposite. More than half of all silver demand comes from industrial applications that have no substitute. Solar panels, electronics, medical equipment, and water purification systems all require silver's unique properties that no other element can replicate at scale. What happens to price when you have a monetary metal? Scarcity combined with an industrial metal is irreplaceable necessity. We're about to find out, and the International Energy Agency's projections tell us exactly why triple-digit silver is mathematical certainty rather than speculation. Solar panel manufacturing will consume 85 to 98% of current global silver reserves by 2050. Not current production, current reserves. That's every ounce we know exists in the ground, every mine we've discovered, every deposit we've mapped. The clean energy transition isn't slowing down, it's accelerating, and every solar installation removes silver from the supply chain permanently because recycling technology can't recover it economically from photovoltaic cells. Our government set a target of carbon neutrality by 2050. The European Union made the same pledge. China is building solar capacity faster than anyone thought possible. These aren't flexible goals that politicians can abandon when they become inconvenient. They are infrastructure commitments backed by trillions in spending that's already allocated, and every single solar panel requires silver that's becoming harder to find each month. So when someone tells you $75 silver is expensive, ask them what industrial manufacturers will pay when they literally cannot build their products without it. Ask them what solar companies will bid when their billion-dollar installations sit incomplete, because they can source the one component that makes photovoltaic cells work. Ask them what happens when 85 to 98% of global reserves are already committed to projects that haven't even broken ground yet. The market is starting to wake up to this reality, and that's creating the most dangerous situation for those banks holding massive short positions. January 2nd is when institutional investors rebalance their portfolios for the new quarter. Pension funds, hedge funds, and sovereign wealth funds all run the same algorithms, review the same performance data, and make allocation decisions based on which assets delivered the best returns over the previous months. Silver returned 158% in 2024. The S&P 500 was up about 24%. Bonds barely kept pace with inflation. When portfolio managers run their quarterly reviews and see silver outperforming every traditional asset class by a factor of 6, they're going to chase that momentum regardless of current prices because their job is delivering returns, not predicting tops. Here's what should terrify those 5 banks still holding short positions. The institutional money that is coming in January didn't get the $70 entry point. They watched from the sidelines while silver doubled. They told themselves it was a bubble that would pop, and now they're facing performance pressure from their clients who want to know why they missed the biggest commodity rally in modern history. Those institutions are sitting on over $100 billion in dry powder, specifically allocated for alternative assets and inflation hedges. When they decide to chase silver's momentum, they're not buying 10,000 ounces for a small position. They're buying millions of ounces to hit their allocation targets, and they're doing it in a market that only has 210 million ounces of available inventory against annual demand of 1.19 billion ounces. Do the math with me one more time. The remaining COMEX and LBMA inventories represent roughly 17% of annual global demand. We're already 3/4 sold out before the January institutional wave even begins. What happens to price when $100 billion in institutional capital tries to buy meaningful positions in a market that is already rationing supply to industrial customers? That unnamed bank that liquidated in October, they saw this coming. They probably took massive losses closing their short position, probably triggered internal risk alarms that required board-level meetings, probably lost traders their jobs and bonuses. But they're out. They survived. They'll rebuild their commodity desk next year when the dust settles. The other four banks are playing a game of chicken with mathematics that cannot be argued with. Every day they hold those short positions, they're betting that either demand will collapse, new supply will materialize, or prices will somehow retreat despite every fundamental indicator pointing toward scarcity. They're betting against refiners shutting down, sovereign nations hoarding, industrial buyers paying premiums, and exchanges halting trading to prevent cascade failures. One of them will break next. It's not a question of if, it's a question of when and which institution's name appears in the headlines. The smart money is watching for Q1 2025 earnings reports, where a major bank quietly mentions significant losses from commodity derivative exposure. That's when the general public will discover what industry insiders already know. Our financial institutions have been running a fractional reserve system in the silver market that makes 2008's subprime mortgage crisis look conservative by comparison. When that announcement hits, when regular Americans see a trusted bank brought down by silver derivatives, the psychology changes overnight. Silver won't be some obscure commodity that financial nerds argue about on internet forums. It'll be front page news, cable television talking heads explaining short squeezes to viewers who've never heard the term before, and millions of investors simultaneously realizing they want physical exposure to the one asset that just destroyed a major financial institution. That's when silver goes no bid. That's when you check the spot price and see $75, but every dealer is either sold out or quoting delivery premiums of $50 to $100 over spot. That's when the COMEX vaults hit zero. The Shanghai Gold Exchange stops reporting numbers, and the only silver changing hands is between private parties negotiating prices that would have seemed insane 6 months earlier. Analysts are already whispering price targets that sound absurd until you understand the supply dynamics. $150 by mid-2025 if institutional buying creates a sustained squeeze. $200 if industrial manufacturers panic and start building strategic stockpiles. $300 if the gold to silver ratio corrects to historical norms while both metals rally together. Those aren't predictions. They're mathematical outcomes based on available supply, confirmed demand, and the behavior we're already witnessing from every sophisticated player in the market. The only question is timing, and everything we've discussed suggests that timing is measured in months rather than years. Think back to that Tuesday morning on October 8th, when India's order broke the London lease rate market. That was the warning shot. That was the moment when everyone paying attention realized the emperor had no clothes, the vaults were mostly empty, and the paper-silver system was built on promises that couldn't be kept. The refiners heard the warning and shut down operations. China heard it and banned exports. South Korea heard it and spent $76 billion securing supply. One major U.S. bank heard it and liquidated their position despite massive losses. The question is whether regular Americans will hear the warning before it's too late to position themselves ahead of what's coming. Because when the next bank fails, when the public announcement finally comes, when silver becomes the most talked about financial story in the country, the opportunity to buy physical metal at anywhere near current prices will be gone. $75 seems expensive right now. 6 months from now, people will look back at this moment the same way we look back at $5 gasoline, thinking it was expensive before it hit $10, or $1,000 gold before it climbed to $4,500. The insiders already positioned themselves. The smart money already moved. The sovereign nations already secured their supply. What regular investors do next will determine whether they protected their wealth ahead of the crisis or spent the next decade wishing they'd understood the warning signs when there was still time to act. The silver shortage isn't coming. It's already here. The only question left is whether you're going to be one of the people who saw it coming or one of the people who wished they had.